The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk and is in everyone's best interest to consult a tax, legal, or investment professional. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Services Corp., member FINRA SIPC, a registered investment advisor. Life Stages Advisory, Dean, and Remington are not affiliated with USA Financial Securities. Welcome to the 27th episode of WTF, Wealth, Taxes, and Finances. I'm your host, John Cyndia, certified public accountant and personal financial specialist. I have Dean and Remington in today.
Hello.
How you doing? I'm back here. Sorry.
Dean's behind the camera today, okay, but he's still on with us because we're going to have a little bit of fun. And I've got a financial literacy thing I'm covering over now because I can see Rem trying to look at it. There's 6 basic questions. We're just going to keep it real simple. We're going to have like a little contest here to see who knows what about this. There's 6 basic financial literacy questions on here, and averages people get 2 of those right. Okay,
I like those odds.
Yeah, that's about a third. So it can be everything from some taxes. It could be about interest rates. It could be about credit scores, educational loans, things like that. And what we want to do is utilize this time. I'm going to have these 6 questions here for these guys and for you out there listening. And then we're going to talk about each question and how it does relate to literacy as a whole, as trying to understand exactly what we've been trying to put together here for the last, how many episodes, As a general rule, how many months' expenses do financial planners, that's me, recommend that you set aside in an emergency fund? That's like cash for something, and furnace goes out, you need $4,000. How much should you have on the side?
This is multiple choice, right?
Oh, yeah, I haven't given you those yet. Okay.
Cool.
I was about to fly off the handle real quick.
Don't get nervous, guys, okay? Now you have to make sure you record these. All right, A, 1 to 3 months, B, 3 to 6 months, C, 6 to 12 months, D, 12 to 15 months. So in other words, if something happened and you needed an extended amount of time that you had to pay for things, what does that emergency fund look like? And just for information purposes, I've got clients that have anywhere from $1,000 to $250,000 in cash at any one point in time. So, if you have an emergency fund, A, B, C, or D?
I'm going to go with C.
Okay.
Hopefully.
Dean?
I'm going to go with B.
Going to go with B. The answer is C, 6 to 12 months. Okay, ding, ding, ding. 1 for Rem, okay?
Just got to go one more and then I'm good. I can miss all the other ones.
Yeah, exactly. You only have one.
I'm nervous now.
Pressure's off. So usually it's like 6 to 12 months. I mean, there's no hard and fast rule, but the way I like to look at it is if you read stuff, everybody's always saying 6 months. And so that is what your household would actually need in a period of 6 months. If in this COVID situation, maybe you've been laid off, you lost your job, they've cut back your hours, you've been furloughed, something like that, and you haven't been able to get any of these other loans or any of the other $600 a week on the to cover your unemployment. The state you're living in doesn't offer enough to get by with your full household expenses. So if you normally spend $2,500 or say $2,000 a month, 6 months, that's $12,000 you should have in this emergency fund.
That's not bad.
So that's 6 months, or it could be 12. And like I say, I've got clients that they're in a panic if they don't have, for no reason except it's their comfort level. They might have $50,000 in cash at any one point in time. So that is a personal preference of how much you should have. But on average, and you know how that goes, rule of thumb is about 6 to 12 months. So 1 for Rem, 0 for Dean. Okay.
Big old
I'm,
goose
I'm
egg.
looking
good.
at
I'm
I'm
good.
looking at Dean. That's
I
the
have
camera
no
guy.
idea what the next questions are, so
That's good because I haven't said anything to anybody. If you have too many credit cards, what should you do? A, close as many as possible. B, request a higher credit limit. C, be cautious about closing credit cards. D, close the cards with the lowest balances.
Is there an option E? Get
No,
the scissors
there's
out and
not.
just cut them.
No. So, all right, we're going to start with Dean this time. What do you think?
all right, ask those again. So there were 3 of them were closed, right?
Let's see. A is close as many as possible. B is request a higher credit limit. C is be cautious about closing credit cards. And D is close the cards with the lowest balances.
I'm gonna say C.
I'm going to go C as well.
Okay, answer is C.
Nice.
Be cautious about closing your credit cards. Okay.
Yeah.
Only 29% of the people answered that one correctly. And on the first one, only 14% got that.
Really?
Correct. Yeah. Yeah. So that's just
You
sort
feel
of
like you're
definitely-
some in some elite
A little bit there.
farm area there,
A
Rem.
little bit.
All right. Now, this is where, yeah, because Rem will miss all the last 4. Anyway, yeah, the thing is about the credit cards that a lot of people aren't aware of is that if they collect them and they've got 15 or 20 of them, and then you just say, okay, I've just had a brilliant idea. I've paid them all off. I'm going to get rid of the credit cards. That actually goes against you.
Yeah.
And you could see your credit scores drop precipitously because of that. The credit is determined on the length is a major issue. How often you get to either have a balance on them and pay those off, but it's also the fact that you're making consistent payments and you're never late on those. So late payments and length of credit history are important. So even if you're not using them, stick them away somewhere or whatever. Just
Yeah.
don't get rid of them.
I was about to ask, like, I'm not saying you should or shouldn't do this, but is the reason that you see people like cutting up the credit cards is so they're not closing them out, but they're also not able to use them. So once they clear everything out, they just cut them. You can't use it anymore, but you're also not closing it out, so you're not harming your credit score.
Exactly,
Okay.
exactly. Because they're going to keep issuing you those, and if you don't have them, there's no penalty unless you've got a card that says, hey, some of these rewards cards or whatever might have like a $45 to $75 or $100 fee on an annual base. You'll be paying those, but from any other type of standpoint, the credit utilization should be below 30%. As long as you're below 30% on all your credit cards. So if you've got $10,000, you stay under $3,000, you're in good shape. If you take that up to like $7,000, $8,000, you're going to get a ding on your credit report. It's just going to, it'll be temporary, obviously, until you pay that back down. And it's the same thing. If you've got $100,000 worth of credit cards and revolving debt that way, 30%, that's $30,000, and you're still in good shape. Okay. All right, you guys ready for number 3?
Oh yeah.
Go for it.
If a late payment is sent to a collections agency, how long will it remain on your credit history, even if you have paid it off? Less than a year, 1 to 3 years, 4 to 5 years, 6 to 7 years.
I'm gonna go with B.
B. Rem
Just
says
hope
1 to
that's
3
right.
years. Dean,
I'm going on the late end, 6 to 7.
6 to 7. Ding, ding.
Oh no.
Dean's got 6
Dang
to
it.
7. That's what it is. It is an unfortunate thing. Several years ago, we were in a process. We were on vacation, and I forgot to make a payment. It was 1 day late, and it took 6 years to get off of that thing. It was, talk about frustrating.
Oh, yeah.
You just sit there and you go, oh my God. But yeah, if that happens, if you can, you're on vacation or something happens and you sit there and you go, oh, you know what? I don't know if I paid that. Call that company up, tell them what's going on, make them aware of it, and try to make some type of an arrangement. It may help, it may not, but at least they'll try and help work with you or put a notice down or something like that. Anything besides just making it late.
Yeah.
And if you can pay it off, use a debit card, take it out of your cash account rather than send the thing in, do electronically, do whatever you can to get it in. But just one stinking day,
Yeah.
is just, it just makes you sick. Okay, number 4. What is the formula for calculating your net worth? Yeah, Dean just about passed out. His brain exploded on that one.
Yeah, I think I did.
Okay. Assets minus liabilities, liabilities minus assets, assets plus liabilities, assets divided by liabilities. Ding, 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 ding.
I got nothing.
Let's see here. Oh, just for an FYI, while they're thinking, that last question, the 6 to 7 years, 62% of the respondents got that correct.
Oh, wow.
So
How's it feel now, Ray?
Oh, boy. Let's see if I can get this one right. Let's...
What were the first two again?
Okay. Assets minus liabilities, liabilities minus assets, assets plus liabilities, assets divided by liabilities.
I think Dean's got the lead on this one. You want to go?
So you can copy me?
Yep.
I'm going to say B.
B. Okay.
That was assets minus liability, right?
Let's see. That was liabilities minus assets.
I'll go with A, just to shake things up a bit.
Oh, shaking things up.
Yeah, it's probably
Well,
not going to pay off.
The answer is A.
Ooh, nice.
Assets minus liabilities.
I knew that the whole time, I swear.
47% got that question right. So, yeah, even if you haven't taken an accounting class, it's what's your assets, all the stuff you have versus what you still owe on that, on everything. Rem's just got a new house, so he's totally broke now at this point. But you've got assets minus your liabilities equal is what your equity is, or your net worth. So once you add up your cars, house if you have one, all your little toys and trinkets and everything else, and subtract all your mortgage debt, credit card debt, car loans, whatever, that bottom line is your net worth. And that's what the banks will look at a lot in addition to your income and say, is this person a good risk for loaning money? So that's it. So score so far, is it Remington?
3-2.
3 to
I have
2.
2. Yeah, I have 2.
All right, they're average going on above average here. Okay, the 5th one. Imagine that the interest rate on your savings account was 1% per year. Okay, yet inflation is 2%. After 1 year, would your ability to buy something with the money in this account be more than today, less than today, exactly the same, or you don't know? So your savings account, you're getting 1%.
Right.
Inflation's 2%. So that's, you're going to have some type of effect, or is it, on what you're doing? Because you have to think of compounding. It could be
Right.
simple. It could be all kinds of things.
Read
Yeah.
read those answers again one more time for me.
All right, more than today. So 1 year from today, your savings account would have more. You have 1% interest, 2% inflation. You either have more money, you have less than today, you have the same, or you have no clue.
Let's say, oh man, I feel like I'm trying to do something like, oh man, let's go. Let's see A. I'm just gonna keep with A.
A, more than today. Dean.
His eyes
Dean's over
glazed
there.
over. He's out.
Maybe I'm trying to overthink it, but
Yeah, I feel like that's what I'm doing.
probably.
Yes.
You have $1,000.
Yes.
Inflation's 2%,
Right. And you're earning 1.
and I'm earning 1.
Right.
That means I'm losing 1.
Is that what that means?
I think so.
So what's your answer? You don't know. Yeah,
Less
we don't
money.
know. You're going to have less money.
Less money.
Okay.
feel like-
Dean
Oh, yeah.
is right.
Dang
Less.
it.
You'll have less than today.
Tied
That
through
makes
to
sense.
now-
Now
now
we
it's
kind of talked it out. Yeah,
Yeah,
makes sense.
now it's tied. Yeah, because if according to that, you said how much? 10,000 or 1,000?
I just said 1,000.
All right. So you had 1,000. You're going to earn 10, but inflation is 2, so you're losing 20. So you're going to have $990 basically, if you look at it from that standpoint. So you're going to have less money because of that, and that's why some people that go into the savings accounts. And I had some clients in the last few weeks calling up and saying, I've got some idle cash. And I said, you understand when we put that cash there, that's that emergency fund cash we talked about earlier. You don't need that to do anything. It is doing its thing in cash, not earning anything. And if it's in there and it earns 2 basis points, and banks are looking to try and entice people with 25 basis points and sticking it in there for 18 months to a year, 2 years. Some people are getting 0.5% and considering putting their money in for 3 years. You're not talking big bucks here, okay, from that standpoint. It's not worth tying that money up. I'd rather have it free sitting there, because $50 or $100, if you've got some money saved, that $50 to $100 isn't going to change your lifestyle, but accessing that may, and you're going to get some penalties. They may be insignificant, but they could still be significant to that individual. So I'd rather have clear access to that cash. And like I said before in previous episodes, when you're having that, you're having your emergency fund or that cash that's in there, that's a tool, and it is doing its job by sitting there accessible for you. So if that furnace goes out and you need $4,000 or $5,000, boom, it's there. If you have a car repair, something happens, you got a $1,000 brake job on a car, boom, it's there. No credit cards, nothing else. You don't have to break a CD. You don't have to go do anything like that. It's there in cash or savings, and that's what it's for. Excuse me. So once you have that, don't worry about if it's making anything. That's what the other investments are for. We put them in to work for you from that standpoint. So that's pretty much all I need to say on that. So we're tied up 3-3. Final question. Which of the following about federal student loans is not true?
I have a student loan. I'm excited.
I don't. Oh, no.
For certain federal loan, this is A. For certain federal loans, the interest on your loan is paid by the government while you are in school or during grace periods. B. Your parents must sign a promissory note before loan funds are distributed. C. Entrance loan counseling for all first-time borrowers is required. So,
just the 3?
Just the 3 on this one, yeah. So which of the following about federal student loans is not true?
Was not.
Not true.
Okay, run through those one more time.
Sure. So
I was looking for the one that was true.
Yeah. So it's not true. So they're all not true, right?
Mm-hmm.
I can put a 4th one in and say I have no clue. I can do that too. For certain federal programs, the interest on your loan is paid by the government while you are in school or during grace periods. B. Your parents must sign a promissory note before loan funds are distributed. And C. Entrance loan counseling for all first-time borrowers is required.
Go ahead, Rem.
Entrance counseling? Oh, that doesn't sound like a real thing. Let's go with that. Let's do entrance.
C.
Or
entrance loan counseling.
What was the first one?
Okay. For certain federal loan programs, the interest on your loan is paid by the government while you're in
That doesn't
school.
seem like something they would do. Oh, that's...
You're going to go with C?
No. I'm trying to think, would the government do that, or would they make you do count? Let's go A. I don't think they would pay for stuff.
Okay, A. Dean. You have to see Dean's face. Dean.
Sorry, but you can't. I'm a mystery man.
Not today.
I'm going to say A also.
Okay. And the answer is B. So it's not true that your parents must sign a promissory note before funds are distributed. A lot of them do, but they don't have to.
Oh.
Yeah. Did they sign for there? Honestly, I can't remember. Okay. Stop making payments and see if they get a bill to pay that. Let's see. The previous one, I forgot to say, on the interest rate, only 16% got that right. And on this last one, 34% got it right. So you guys ended up 3 and 3, huh?
Yeah,
So
It's not bad. We're above average.
one above average. That's not too bad. But when you're going through it, like, these are just sort of general questions. Do you guys, what does it mean to you from that standpoint? Does it sound like, do you feel comfortable with what you may know? It's only 6 random questions, okay,
Right.
and stuff. But I think any of that is just fun to know.
Yeah,
when it
and
gets
some
to that
some of
point.
the stuff, I mean, like the thing about the credit cards, I think that's something my dad had told me from like a very young age, like when I was first starting to get like a debit card through the bank for like my student card. It was something like, if you ever have to close anything out, don't. Just make sure it's all paid off. Just cut it up if you need to. He was the one that was always telling me, like, just make sure it's all cleared out and then just cut it up, because I think they had some issues with credit cards in the past. So it was something I'd seen firsthand where it's like, just cut it up, don't use it.
Yeah.
And that's it. Never close or cancel anything.
Yeah.
And the same thing with the interest, like that was the first question. It's all stuff that I somewhat am familiar with, but some of the other ones on there I just shot in the dark guessing, but it kind of makes sense now looking back on it.
Dean?
Yeah, I feel pretty similar to Rem in terms of I mean, I think you can always know more, but I feel pretty comfortable. But
Yeah.
I've got 2 more.
Uh-oh.
These are
Bonus
sort of
round.
bonus round,
bonus
just to see if
bonus round.
see if we got. These are basically from a real basic investment perspective, and it's on bonds and then stocks. Okay, so these are additional questions. One is, if interest rates rise, which the head of the Fed just mentioned that they may not raise interest rates now until 2022, something like that, okay? But if interest rates rise, what will typically happen to bond prices? They'll rise, they'll fall, they'll stay the same. There's no relationship between the bond prices and interest rates. You don't know, or I'm an idiot for asking these last 2 bonus questions.
Well, going off just kind of like context clues here, the fact that you said that they're not going to increase it makes me feel like if they were to do that, especially with everything going on right now, that would have some form of a negative effect. So I'm going to say that they would fall. I think it was option B, right? They would fall.
They would rise or they would fall.
Yeah, I'm going to go with they would fall, because they wouldn't not. If they would rise, I feel like that they would want to do that. So I'm going to go with they're going to fall.
Okay.
I'm gonna say there's no correlation.
You're going to say no correlation. There is. They would fall. So there's an inverse relationship with interest rates. He's
Celebrating.
All right, he's flexing over here. Anyway, so there's an inverse relationship with interest rates and bond prices. And what happens is, and we're talking to the principle of that, doesn't necessarily have to deal with the actual rate. So if a bond's $1,000 and it has say a 10% rate on it, and rates go up, now all of a sudden, and say they went from 5 to 6%. Well, if the rates go up and you've already purchased one at 5, that means you've gotten a discount. So in order to buy something similar, the price of that one goes down, okay? Because now you can get something at 6% where you're earning 5. So in order to make that competitive, somebody has to say, yeah, that's only worth, that $1,000 bond's worth $900. So to give me an opportunity to be fairly competitive, that price is going to go down. Consequently, if the rates were high, like they were about, say 10, 12 years ago, and they went down, bonds were making 14, 15% returns because they went from 8% all the way down to almost zero. So now all of a sudden that principal goes up, rates are down, your yields are terrible. Okay, so you're not going to make much, but it's that equity buildup that you have in there. Okay, and the last one is in here on stock. Buying a single company's stock usually provides a safer return than a mutual fund. True, false, you don't know, prefer not to say. Buying a single company's stock provides a safer return than a stock mutual fund.
Single company.
False.
Yeah, I'm going to go with false on there too.
That's true.
Oh.
Why? Besides just guessing, why would that be? Because you could pick a lousy stock, you think it's good, and you lose everything. Whereas if you had a mutual fund, there's several stocks in that, 50 to 100 or whatever. So that's where we talked previously about in previous episodes about allocation and making sure that you don't put all your eggs in one basket. You don't put all your money into one stock. Okay?
Yeah, that makes sense.
So, and you could probably Google it, do some homework. You can see where there are calculations that are done that says if you had 5 stocks and you put 20% into 5 stocks and one went bankrupt, one went up, all this stuff, that you could still end up having a gain in your portfolio, even though you lost one of the stocks totally. So you can go through those, Google some of that stuff, and see how that correlation is. But when you're looking at that, it's because you don't have everything in one. You shouldn't put more than, I'd say, 10% normally into any, like on these 401ks, and they'll say, oh, we're going to match you with a company stock. Okay, Enron's a good example to go back why you shouldn't do it. Some other ones are out there too, but we try to limit that to at least maybe 10, 15%, definitely no more than 20. But some people end up having all their money into that company stock. If it's good, it could be great. If it's not, you're betting, most, if not all, your pension on that stuff. So anyway, today, how you guys feel about learn anything?
Yeah, and I feel like I went into this expecting to just bomb and do terrible, but
you're above average.
Yeah, above average. It feels good to know that I know some of this stuff.
Yeah.
And I don't want to say I only took a shot in the dark on two or three of these. So
you took a shot in the dark on all 6.
Yeah,
Is that right?
Really good guesser over here.
That's what I did. That's what
Dean
I
was
did.
over here flipping a coin, going, "Oh, let's see," and
yeah, that sounds good.
And he got 50%. Okay. All right. Well, until next time, we want to thank you for tuning in. Please like us. Is that what we have to do? Like us on this video,
like, subscribe, share,
podcast, whatever.
Yeah.
And as usual, give us your feedback. Jay Cindy at Life Stages Advisory. For the time being, until we get we're looking for other emails out there that will sort of help us find out exactly what it is we can help you with. So until next time, thanks a lot. Talk to you soon.